TD Securities expecting a pullback in treasuries to be short-lived, writing the following. The rise in rates has been driven by supply. We're fading it. The virus is still raging, the recovery is stalled, and there's some big risk factors with the Phase 4 deal and US election. TD's Priya Misra joins us right now. Priya, is that all it is for you then? Supply jitters this week, 3-year yesterday, 10s today, 30s tomorrow?
Yes, I think so. And, we had been sort of coiling in this very narrow range, 50 to 55 basis points on the 10-year. So there wasn't really any setup. And as we heard from Treasury, tons of supply, long end duration supply. So I think the market's setting up for it. Yesterday's pre-year auction went well. I think the setup actually bodes very well for the 10-year and the 30-year. So I think once the auction's out of the way, you look ahead and then you realize all the same risk factors that were there last week, they're still there. I don't buy that we're about to head off into high inflation. I think the economic environment is still very challenging. So I would use any opportunity to set bet, of higher rates to actually buy into it here.
Priya, I'd like to build on this because it's a conversation I started the week on with Matt Hornback of Morgan Stanley, just how dominant the force will be, the force being here, supply, through the week. How important is Treasury supply for where Treasury yields go?
When everything else is equal, supply matters. But we're in an environment where everything is not equal. We've got tons of other sort of cross currents. And so I think supply matters on the day. I would also highlight that given the new market structure that we're living in, where liquidity just seems a little worse post-March, I think actually supply ends up being liquidity events for the market. So if I need duration and I know there's a big auction coming up, I might wait until the auction to actually buy. So I think we get sort of a lot more volumes in the auction week. So to that extent, it matters. But beyond the setup, I don't think supply matters when there's a ton of demand out there for duration.
Priya, I'm sure you've had the most amount of calls ever on real yields, perhaps since your time on Wall Street. And I'm just wondering, Priya, when you receive those calls at the moment, what are you telling people?
I'm telling them to watch the Fed. I think it's a Fed. It's not the stagflation thesis. I don't buy that that's what the market's pricing in. Real yields are really a function of Fed policy. And if the Fed is being dovish, and look at all the Fed officials in the last few months have come out extremely dovish. We don't even need to look at whether they're a hawk or a dove. They're talking about the virus risk, the structural damage risk. And if they're telling us they're not about to hike until PCE goes above 2%, which actually means CPI above 2.5 on average, and they're telling us that they might be extending out in duration, real yields can go more negative because that's the Fed tool really to try and force people out the curve to take more risk to help investment. So it's Fed policy, I think, that's driving real rates here. I would watch that September Fed meeting very closely.